Hello everyone. Today we are starting with first chapter of economics as we discussed earlier. So economics, we have segregated entire economics into 6 chapters, right? So first chapter is evolution of Indian economy. Second is monetary and fiscal policy. Third is external sector. Fourth, financial market. Fifth, sectors of economy. And sixth, we have survey budget. Okay, these are the things. We will start with first chapter today. In that, we will be studying about GDP, GNP, NNP, etc. and about inclusion development. Also, we will complete 5-year plans and the difference between Planning Commission and Niti Aayog, and how did we do that transition, that also will understand. Later we'll focus on demographics. Also about poverty and unemployment we will study in depth. Okay. So first chapter we will complete on GDP and related concepts. Okay. So in this we'll understand what is GDP, what is GNP and its meaning. So who will measure this GDP and GNP? So it's NSO, National Statistic Organization under MOSPI. Okay, we'll see this as well. Then what different methods of measuring GDP, like income method of GDP calculation, expenditure method, all these things we will learn. Along with that, the difference between growth and the development also we'll check. And GDP as a concept of development also we'll have a look into. Okay, these are some of the points we are going to cover today. Okay, so if you see GDP, it is very important that you should understand it properly. What is GDP? Gross domestic product. What does it mean? Gross domestic product. So you should know the definition accurately. Gross domestic product. So gross is total, right? Domestic within our country. Product, together we are saying goods and services produced in a boundary of a country in a given time. So that's how we will be terming the GDP as. Okay. So it is like the total value, the total monetary value. It should have some value, right? The total monetary value of final goods and services. It should be final goods, consumable goods, not the intermediary goods. It is final goods and services produced in a territory of a economy in a given accounting or financial year. It's called as GDP of that nation. For us financial year, we know that is from April to till March. That is AM abbreviation, you can remember. Okay. So what is GDP? It is a total value or monetary value of a final goods and services produced in a domestic territory in a given accounting period or a financial year. It's called as the GDP of that nation. So now we will break the term and understand. Okay. First thing. So it's a monetary value. Fine. Then we should understand. See, they are saying if this is a boundary of a country, what and all the different goods and services produced within this country. It may be produced by foreigners or by nationals. We are not thinking on that aspect, but we are thinking on all final and final goods and services that are produced within a boundary of a country in a given year, right? That is financial year. So if you want to get some more clarity on boundary, that is, one is territorial boundary. Even land and sea boundary also we consider. So land and sea boundary, in sea boundary it is around 12 nautical miles. Okay. Then we have even aircrafts and ship operated by resident of India is also under our territory only. So even aircrafts, ships operated by resident of India is coming under GDP. Okay. Then natural gas, oil platforms operated by resident of India. It should be by resident of India. We are staying in India. Okay. So that is also under boundary of a country. Also even embassies and consulates. This is also a part of boundary of a country. You should know that thoroughly, okay? So what is boundary of country? Land and sea boundary, aircraft and ship operated by resident, natural gas and oil platform operated by resident, also embassies and consulates, okay? You understood? So this is GDP, gross domestic product. Now we'll see what is GNP. It is gross national product. Okay, we'll understand what is it. Say for example, this is a country and this is outside a country, entire world. Indian nationals are present here, even here, outside India also. And if you see, foreigners also present in India as well as outside India, right? Now in GNP, we focus on the products, final goods and services produced by nationals alone. Nationals. This red mark is nationals. Nationals anywhere in the world. Even these nationals, they are not inside India, but still there are nationals. So nationals of India. The goods and services produced by nationals of India, it is GNP, as part of GNP. Understood? So if you focus, what is GDP? GDP within the boundary, even if it is foreigner or residents, if it is inside the boundary of country, then it is GDP. But what is GNP? Gross national product. It is about nationals. They may present anywhere. They may present within the country or outside country, but they are nationals of one single country, right? So we consider them for a GNP. We won't consider foreigners there. We will minus foreigners. Okay. So for that I can simply say, how can I represent it? So this is GDP is what we'll consider, and this is GNP. Okay, red people are one country nationals, okay? So if you say GDP, how can we write GDP and GNP relation? GNP, if you see GNP is equal to GDP. Whatever GDP is there, countries also, countries GDP first we will take GDP. Then from GDP we should take out all blue people, no, because they are not nationals, they are foreigners. So minus foreigners in India, okay? Then we should add whoever nationals outside India to India's GNP. Okay, this red. So plus input, that is we said it as net factor from abroad. This is said to be net factor from abroad, FI plus IO. Okay, that is equal to net income from foreign to India minus net income from India to foreign. Okay, so it's very simple, don't get confused. Again I'll explain in a simple way. I hope you understood already, but still. So if goods and services are produced within India, it might be by nationals or foreigners. In India there are both foreigners as well as Indians, right? So we consider it as a GDP. We consider only what is the final goods and service within the boundary. That is GDP. It may be by Indians or foreigners. Everything will combine and take. But if you want to take GNP, that is gross national. In the word itself we are mentioning, right? Nationals. Now we are focusing on nationals, not the foreigners. We want the income or the monetary value of final goods and services produced by nationals of a country. So nationals in the sense they might be inside the country or outside the country. We want only national. So we'll take IO, that is net income from foreign to India, and net income from India to foreign. We minus that, okay? We have to take out all the foreigners' contribution. We have to include all the national contribution. If you do that, that is said to be net factor from abroad. Okay, this is net factor from abroad. That is equal to GNP is equal to GDP minus FI, that is income from foreign, income from foreign to India plus net income from India to foreign. Okay. So this is net income from India to foreign. Okay. We have to take from, see, we should count, we should plus what? The income from foreign by Indians. That is plussing. See, I am doing IO. It is Indian income. And we should minus the foreigner's income. That is income from foreign net income from India to foreign. This is by foreigners, right? So whatever it is generated in India, but it is not by nationals, we will minus. It is foreigners, right? F is foreigners, right? So we will minus whatever from Indians, but from outside the country or territory, it is called as net income from foreign to India. Okay, that simple it is. So now you say which is higher, GNP or GDP? GDP is higher than GNP. Why? Why GDP is higher than GNP? Why? Because see, we are writing in terms of this. The income going out of India is more to foreign. So GDP is higher. When you combine both foreigners and India's income, that is more compared to GNP. Okay. More income to foreign is going out. That is the reason GDP is more for us. So what is GNP? It is GDP plus net factor from abroad. It's a net factor from abroad. So in GDP, we are talking only about goods and services produced. That too, it should be final. So we won't include any remittance. See, remittance is kind of transfer done from foreigners to Indians, right? Or Indians or other countries, correct, to natives. But we are not producing any goods or services, right? So this can't be included. Then transfer payments also can't be included. Transfer payments will be not producing any goods or services. Okay, these are not included in either GDP or GNP. Got it? That's about what is GDP, what is GNP. So, to understand what is the final goods and service, say for example, cotton is there. From that we will produce yarn. And then it will become a cloth, which is an intermediate good. Yarn and cloth is an intermediate good. If it become t-shirt and that is going for a consumption, this is a final good. Yarn is an intermediate good. I won't calculate yarn, but I will calculate shirt, okay, as a final good. So there should be no more transformation. That is said to be final good. And it should not be for sale also. It should not be transformed further, or it should not be for sale. Such goods are said to be final goods. So final goods we are considering consumer goods and services, plus even capital goods we are considering as final goods. These are addition of a capital. That means investment, okay. Capital goods, again these are not consumed in the process, but they are used for a long run. That's why even capital goods are said to be final goods. Okay, you should remember what all will come under final goods. It will come, one is consumer goods. We already saw what is that. Example, shirt. Capital goods like machines and investments. So in economics, if you talk about investment, we are talking about addition of capital goods, etc. It's not about share market investment, okay. We are talking about capital, okay, fine. Use based classification of final goods and services. So we understood what is consumer goods and services, capital goods and services, and also intermediate goods, okay. We have seen already what is intermediate good, that yarn in the process of converting cotton to shirt is an intermediate good. So yarn is an intermediate good, right? once again if you see consumer goods and services, all those goods and services which are used for final satisfaction of a consumer. It's a consumer good. If you are using the sugar that you bought for consumption, then it is a final good. Or if you are using it for making a cake, then it becomes intermediate goods, right? Then capital goods. It is also an input, but for a long time. All those goods and services which are used for further production, they are used for further production for a long time. Long period it should be there. If it is a short period, then it is an intermediate good, right? So for a long period we are using, that is capital goods. Addition of capital is called as investment. Capital good, for example, tractors in farming is a capital good. Okay. Then intermediate goods, all those goods and services which are used for further production of goods and services for the sale in market but completely utilized during the production process. So these are consumed and then a final good is produced. That's why it is called as intermediate. What do you mean by intermediates? In between, right? Intermediate goods. Okay. So whatever classification I said, it is according to System of National Income Accounting 1992. Okay. It is revised in 2008 also. So that's about GDP, GNP and final goods we understood. So if you see here, I have a definition for GNP as well. Total value of goods and services produced by a resident of a country in a given accounting year is called GNP of that nation. So GNP is equal to GDP plus net factor income. We have seen this also. For India it is negative. That's why GDP is more. Because more income is going out of India to foreign. So in capital goods we should also note one term, that is depreciation. That is loss in a value of a capital good due to its normal wear and tear. So every year the depreciation will go on. Okay. Why I mentioned this is, you note this depreciation. Loss in the value of a capital good. Tractor, if it is say for example some 10,000, it is not 10,000, still take like some 10,000. Next year it can't be the same. It might go for 8,000. Why? Because there will be a loss of value because of wear and tear. Okay. So what we do, if 4 machines are produced in a year, 5 machines are produced in a year, we consider only 4 machines. 1 machine we consider as depreciation. Therefore, total produced good calculated to be only 4 machines. Why? 1 machine we left as depreciated good. Okay. So in that we can learn 2 different terms now. NDP and NNP. Net domestic product. We seen gross, total, right? From gross, if you minus depreciation, that wear and tear, that becomes net domestic product. Similarly, NNP, net national product, GNP minus depreciation. So we are considering actually produced goods by removing out all the depreciations in that particular year. Okay. So this is all about GDP, GNP, NNP, NDP. We are done with 4 terms. Now we will little focus on what is growth. So we use all these things to measure growth. Okay. Then what is growth? Growth, we talk how much the quantity increased. Whenever you talk about growth, it's a quantitative accounting one. We will always think how much has been produced, how many has been produced. That is what is growth. Okay. We want quantity here. Quantity of goods. Is it 10? Is it 12? If it is 10, from 5 it has been increased to 10, the quantity, then we say yes, there is a growth. Because we are counting on the quantity here. So in that we have one more term, that is GDP real or GDP base year or GDP at constant price. Now we see what do you mean by GDP at real price or GDP as base year, GDP at constant price. For that we will take one example. Say for example in 2011-12 a product Q, product A has been produced. Number of products produced is quantity is 100 and the price was 10 rupees. So with that the final value was 1000 rupees. Okay. In the second year, before going to second year, let's say goods B, that is some product B. Number of B produced were quantity is 200. What is the price of it that year? 20 rupees. With that we got 4000 as a value. Total we got 5000 as a value. Okay, this is in 2011 and 12. Next, the same material A. The next year they produced 200 and the price remains same, 10 rupees. So it made 2000 rupees now. So number of quantity increased, so the price increased. So it's a growth. Again, product B, number of products B produced is 400. That means 200 more increased. And the price remained same, that is 20 rupees only. So it was 8000. Total 10,000. There is an increase in quantity actually, not the price. Then it is said to be a growth. Number of products produced has been increased. So that is said to be a growth, right? So that is GDP real or GDP base year or GDP on constant price. That is also said to be nominal GDP. Okay? Sorry, not nominal GDP. That is real GDP. We were reading about GDP real base year or at constant price, right? We are focusing here on the base year. Compared to 2011 and 12, how many quantity got increased? Based on that, we are calculating the GDP. If the price is not getting changed and the quantity is increased, then it is said to be real GDP. We are comparing with the previous year's base year's price. Okay, if you consider base year price and you are calculating, that is real GDP. Otherwise, say for example, the similar products. So in 2011-12, product A was produced 100, price was 10. So 1000 rupees. B 200 number, 20 rupees, 4000, total 5000. So we have seen the price also, quantity also. Now, so they have produced in the next year 200. A has produced 200, but the price also increased to 20. Inflation is there, so price also increased. If it was same, then it is real GDP. With reference to this we have taken. But it has changed according to the inflation. It is 20 rupees now for product A. Now it is 400 rupees. And the product B, they produce 400 only. But the price is not same as previous year. But it is increased to 30 rupees because of inflation. And whatever you calculate now, that is nominal GDP. See, there is a difference between nominal and real GDP. If you see real GDP, it is only 10,000. But nominal GDP, it is showing 16,000. But same number of A and B products. How? Why this difference? The difference comes because of inflation, increase in the price of that goods. Right? So, whenever we want to calculate or compare our growth, we should go with real GDP. We should go with if the same price existed, what was the price we would have got. That will give you number of extra quantity you have produced. If you are going with nominal GDP, say for example, this year also they produced 100 only. And the price is 20 rupees. So total price will become 2000. In the previous year, again they used to produce only 100. But at the time price was 10 rupees. So it was only 1000 rupees. So now if you see the difference, it is 1000. That means is there any growth? No, there is no growth. Last year also they produced only 100 products. Even this year they produced only 100 products. The only change was price. So this can't be the growth. Inflation can't be the growth. So number of quantity should be the growth. It didn't change. So there is no growth actually. This is what is shown in real GDP or GDP at base price or GDP at constant price or GDP at base year. Okay. whatever they are changing according to the inflation, we call it as nominal GDP. Okay. Hope you would have understood. If any doubts, comment below. Okay. So to find the difference between nominal GDP and real GDP, we are using another tool called GDP deflator. So what is GDP deflator? See. So if you see here, GDP deflator is GDP nominal divided by GDP real. So GDP nominal is what? Quantity, number of goods produced into price, right? Divided by number of goods produced into price. But here we have something called inflation also. Price got increased. So if you cancel this, what we get? Inflation is what we get. The difference based on inflation is what GDP deflator will show. So if it is deflator is more inflation is there. If the deflator is almost near to 1, then there is no much of inflation. This is what is a GDP deflator. GDP nominal divided by GDP real. Okay. Hope you understood. So nominal GDP also said to be GDP at market price, today's price. Okay. Inflation is counted in nominal GDP. There is some impurity in this because inflation is also counted in nominal GDP. That's about GDP nominal, GDP real. Now we'll understand what is GDP at factor cost, what is GDP at market cost. For example, you say near to the factory, at factory, you consumed 8 rupees for product production and 2 rupees as a profit, and the total spent was 10 rupees. So GDP at factor cost at factory, what is it? 10. But while you are going from factory till market, you have to use the road, and you also get certain benefits from the government if you are doing a good work. So that is because you are using a road, you have to face some tax, and because you are doing some good work, government also will provide certain subsidies. Subsidies means your cost will be reduced, right? You don't need to pay that much of cost. So plus tax minus subsidies, that is equal to GDP at cost market price. Okay. Once you reach market, along with factor cost, GDP at factor cost, you would have also paid tax, and you would also got some benefits, right? That is subsidies. So that is should be equal to GDP at market cost. Okay. Okay. So GDP at market price, when GDP is calculated including the value of net indirect taxes. So we say in total indirect tax plus minus subsidy as net indirect taxes. Okay. Then you have to note down GDP figures. You can note it in the month of February when the budget and survey comes out. So you can note down recent figures. Okay. So as of now, India is in a 5th largest GDP holder after China, USA, China, Japan, Germany, and then comes India. Okay, you can remember this. USA, China, Japan, Germany. It's Germany, and then India. Okay. Then note down the GDP real, GDP nominal of 2020, 24 and 25. Okay. Then we'll see what is GDP PPP. That is purchase power parity. So we will measure this. It is measured by IMF and World Bank. IMF, World Bank, these things. Purchase power parity. That means what the word itself is saying. Purchasing power. And how much parity we have with other countries. So if you see, if two countries have same rate of inflation, then PPP exchange rate will remain constant. So what does it mean by purchase power parity? How much parity we have in purchasing power? So that is to buy same commodity in different countries. How much money you will be spending. For example, there are basket of goods. Okay, first of all, you want to buy a basket of goods. If I spend 100 rupees in India, I will get 4 apples. The same thing if you go to USA and spend 100 rupee, how many apples will you get? Is purchasing power parity. You might get only 2. So purchasing power is more for India, right? That's how it is. So, but it is not true. I am saying for example. Okay. So India is in third largest in purchasing power parity after China. First is China, then USA, and then comes India. In GDP terms, India is 5th. In purchasing power parity, India is 3rd. After China, USA, India is in 3rd position. Okay, understood, I hope. So if you want PPP definition, the price of goods will be same in both the countries when converted at PPP exchange rate according to PPP. Okay. So that's about purchasing power parity. You should know what is it. That is what is needed for now. I will say when you want to memorize certain terms for mains, I will teach you. This is all prelims portion. Okay. Income method of GDP calculation. Now we are talking about GDP, right? So how will we calculate that? There are different methods. One such method is income method. Okay. First, who will calculate this? That should be known. It is calculated by National Statistics Organization. So it is under which ministry? Ministry of Statistics and Program Implementation. Okay, MOSPI. NSO will calculate. NSO is combination of CSO plus NSSO, National Sample Survey Organization plus Central Statistic Organization. Financial year has been introduced by British in 1867. It was introduced in 1867. Okay. Base year changed in 2014 to 15 from 2004 to 5 to 2011 to 12. So I was saying about GDP real, GDP at base price, right? So that base year has been changed from 2004 5 to 2011 and 12. What is the base year now? 2011 12. Okay. How we will choose a base year? We will choose such a way that it is a normal year. There should be no war, no much of drought or no bumper production. There should be no extreme things. It should be a normal year. Such year we will choose as a base year. Okay. So now to understand income method of calculating GDP, first we have to understand circular flow of income. See, in an ideal economy you think, if all the households are going for a work, okay, to produce goods. Say this, they are going for a work to produce goods, okay. They are getting salary. So factor payment should be given to households. They went, they worked, they got all the money. Again, the money they got, where they will spend? They spend to the farm only to buy whatever the goods produced. And whatever farm has produced goods, for whom it is produced? To sell for households. So it's a circular flow, right? This is for just an explanation. No need to memorize nothing. Okay. So under that, if you see factors of production, there are 4 factors. Labor, land, capital and entrepreneurship. So and the payment comes like this. For labor, what you will give? Wages. For land, rent should be given. If you invest capital, you will get a interest. And for entrepreneurship, you will get a profit. These are the factors of production. So, under factors of production, that is what we use to calculate income or GDP as part of income method. We include all wages, rental rates on capital and farm profit. All this together to form as a income method of a production, okay, or GDP. So we just calculate the factors of production in case of income method of calculating GDP. Next we have another method, that is production method. So in this what we have is we will calculate on the value addition. That is, say for example, farmer. So farmer has produced a wheat and worth of rupees 100 rupees. Okay. So some purchaser purchased it for 50 rupees and he made it as a bread and sold for 200 rupees. A baker purchased for 50 rupees and sold it for 200 rupees. So we have calculated already, that is 100. 100 rupees is what the worth of a wheat. We took that and we can't take directly 200 here because he produced worth of 200 because he took only, his expenditure was 50 rupees. So we should take out this because we already calculated in the 100 rupees, right? So now it is only 150 rupees. Is the worth of goods he produced. It should not be like what is entire goods cost. It is like what is the value he added. For 50 rupees whatever he purchased, 150 rupees value addition he has done. So that is 100 plus 150 is equal to 250. This is GDP in production method or value addition method. Okay, that is how we will calculate. So similarly we will calculate for different forms, that is GVA 1 plus GVA 2 plus till n. So that is equal to GDP is equal to summation of I equal to 1 to n GVA, gross value added, and I, we remember it. Okay, that is value added is equal to output minus intermediate goods is what I explained here. So total output was 100 rupees and the value he has taken is 50 rupees, right? So that's why we considered only 50 rupees for him and the value addition is 150 in total. Okay, that is about production method. So we also say production method as enterprise method of calculating. So we will be calculating here final value of all goods and services minus intermediate cost. We won't include intermediate cost. Only final cost will include. That is GVA. Okay. So these numbers would have been changed. You have to look in the month of February both survey and budget. Okay. You note that share of GVA by primary, secondary and tertiary sectors. And last year it was more for real estate and then agriculture, trade and other consumption services and then manufacture. This was the sequence. In total it was service and agriculture, then comes manufacture last year. This year you have to note. And finally we left out with expenditure approach. So in expenditure approach we have this C plus I plus G plus NX. What do you mean by it? We already understood the cycle of income, right? Under that what we understood, whatever we produce we will consume. So if you consume more, they will produce more. So to produce more, what should happen? Consumption should be more. So now that is what we are going to talk in expenditure method. That is C. Household consumption is C. Firms, corporates, that consumption is I. And government consumption G. And NX, net import export, that is NX. Okay. So we are considering all the consumptions here. Okay. In household if they consume, see it is C. Okay. Household consumption. I, firms consumption and investment, government consumption, and net export and import, right? So if you do this, you will be able to get. So if you are consuming more, that means more goods has to be produced. Why are you consuming more? Because you have more income, right? When you don't have more income, you can't consume more. That's why we will understand how much growth is happening. If the consumption is going higher, then we will say there is more growth as well, right? So in investment, I is investment, right? If the investment is more, that means savings will go down, right? And the vice versa. So if there is more tax, so in ideal case, investment is equal to savings. How much you are saving, so much investment is available, so much investment is happening. So that is in ideal situation, but practically not. In a closed economy it happens, but not in open economy. Okay. that is about expenditure method. So if you can equate GDP is equal to GBA, summation of GBA, that is equal to C plus I plus G plus net export and import. And we have factor cost, wages plus profit plus investment plus entrepreneurship profit and all, right? Rent. All these things if you add, if you can equate, the GDP will be same only, more or less. So approximately it is same. So we can use any of the method. We have three methods basically. That is what we understood. So that's all about GDP and the national income. So there are certain more terms. The national income, if you say at market price, we already understood. It is equal to factor cost plus taxes minus subsidies. This is already completed. So net national income at market price is called as a national income. Net national product at market price. Okay. That is national income. So this table you can note for easy memorization. See, GDP, this is GDP plus net factor from abroad, that is equal to GNP. Net factor is what? Income from India to abroad and income from abroad to India. We have to minus it, right? Then we have depreciation if you consider, then it is NNP at market price. Then if you are adding indirect taxes and also removing subsidies, it becomes national income at market price. Okay, net national product, that is equal to national income, which we are considering market prices. So this is about our terminologies. Then we can question about growth and development. So I already told what is growth. We consider only the number of products or goods or services produced. Quantity is what we will go for. Whereas development is qualitative one. If you see, growth is accompanied by increase in urbanization, commercialization, industrialization, which is expected to increase productivity of an individual and promote higher standard of living for all. So that's what we think. Growth will definitely improve the standard of living also, but trickling down effect is there, which is not happening properly. See, so if this is a case, if a growth is happening, if I am pushing, it should equally share and improve everyone's life. But what is actually happening is 10% of people are holding 90% of source of income. So trickling down effect is not happening. That is why we are not able to see the development. So if you see quantitative, we go for equality, whereas qualitative, we want equity. For more needed, more benefits has to be given. So that is where the question of or concept of inclusive growth comes in. That means growth of GDP such that it covers all sections of society. Sabka Saath, Sabka Vikas. So there are 4 components or features or pillars of inclusive development: equitable distribution, poverty alleviation, sustainable development, and capability enhancement. That is skill development. So that is what is the thing. We will talk in depth about inclusive development in the next lecture, because this is a mains portion. Here you have to understand in more depth. Okay. GDP as a concept of development, if you see, it's not mandatory. You can't say if GDP is growing, even development is happening, because distribution of GDP is not uniform. Rich becoming richer, poor becoming poorer is seen. And we are not counting non-monetary exchanges like barter system, etc. And there are certain externalities also. For example, if there are refineries which are giving good GDP, but they are polluting water sources, which is a loss for a fisherman. So there are externalities also. So GDP can't be termed as development. It is growth, but not the development. What is development? Development in the sense there should be improving living standard as well as productivity. Okay. So for that only we have used certain things, or we have certain initiative. For sustainable development, one such is Swachh Bharat. For equitable distribution, Jan Dhan Yojana. For poverty alleviation, Manrega. For capability enhancement, Skill India, Digital India, etc. So we'll read about it in depth in upcoming class when I'll teach you what and all the aspects that you have to understand in inclusive development and the pillars of inclusive development for mains perspective. Okay. So that's all for today.